Iran's currency collapse is not just another emerging market headline. It is a textbook example of what happens when inflation, sanctions, policy mismanagement, and loss of confidence converge into a single financial shock. The Iranian rial plunging beyond 1.4 million to the US dollar marks a psychological and economic breaking point that reshapes how the entire economy functions. At this level, the currency no longer serves as a reliable store of value, unit of account, or medium of exchange. For ordinary households, prices stop making sense. For businesses, planning becomes nearly impossible. And for the government, control over economic outcomes erodes rapidly. Official inflation is running above 40%, but real-world inflation for essentials such as food, housing, fuel, and medicine is often far higher. The collapse is not sudden. It is the cumulative result of years of structural pressure. Sanctions have restricted access to foreign currency. Oil revenues remain volatile, and fiscal deficits have increasingly been financed through monetary expansion. As confidence in the real deteriorates, people rush to convert savings into dollars, gold, or hard assets, accelerating the decline further. This creates a self-reinforcing cycle. A weaker currency raises import costs. Higher cost fuel inflation destroys confidence, and lost confidence weakens the currency even more. At extreme levels like 1.4 million per dollar, the economy begins to operate in survival mode rather than growth mode. Pricing shifts from monthly to weekly to daily. Wages lag far behind costs, and informal markets expand as the official system loses credibility. Financially, this is not just inflation, it is monetary breakdown. The rial's collapse is signaling that the public no longer trusts the state's ability to preserve purchasing power. And once that trust is broken, restoring it becomes exponentially harder. This is why currency crises are so dangerous. They are not linear events but accelerations. Iran has crossed from chronic weakness into acute instability, and the consequences now extend beyond economics into social cohesion, political pressure, and regional risk. What makes Iran's currency collapse especially severe is how deeply it distorts every financial signal inside the economy, rendering traditional policy tools almost ineffective. When a currency loses value at this scale, interest rates, subsidies, and wage adjustments stop working the way policymakers intend. Even if authorities raise nominal interest rates, they rarely keep pace with real inflation, which means holding cash or deposits guarantees a loss in purchasing power. This pushes households and businesses into defensive behavior, hoarding goods, buying dollars at any price, speculating in real estate, or converting income into gold and foreign currency the moment it is received. In Iran's case, this behavior is widespread and rational. With inflation officially above 40% and unofficial estimates often much higher, the rial is treated as a temporary transaction tool rather than money meant to be saved. That destroys the domestic banking system's role in capital formation. Banks become conduits for survival liquidity instead of engines of investment. Credit shrinks in real terms. Long-term projects are abandoned, and productive sectors lose access to stable financing. Imports become prohibitively expensive, especially for technology, medicine, and industrial inputs, which further constrains output and reinforces shortages. At the same time, exporters and those with access to foreign currency gain disproportionate power, deepening inequality and social tension. This is a classic feature of currency collapse economies. Wealth becomes concentrated among those closest to hard currency flows, while fixed-income earners and salaried workers fall behind rapidly. The government faces an impossible dilemma. Cutting spending risks unrest. Expanding spending fuels inflation. Tightening currency controls pushes activity underground. Capital controls, multiple exchange rates, and enforcement measures may slow the visible pace of decline. But they cannot restore confidence. In fact, they often worsen it by signaling desperation. Financially, Iran is trapped in what economists call a confidence spiral, where expectations drive outcomes faster than policy can respond. Once the public believes prices will be higher tomorrow, that belief becomes self-fulfilling. Retailers preemptively raise prices, suppliers demand advance payment, and contracts shorten or disappear entirely. The economy loses its time horizon. Planning beyond days or weeks becomes speculative rather than strategic. This is why inflation at these levels is not just about higher prices. It is about the collapse of economic coordination. The Rial's plunge past 1.4 million per dollar is not merely a statistic. It is evidence that the monetary system is no longer anchoring behavior. And when money stops anchoring behavior, economies become volatile, unequal, and increasingly unstable, regardless of how many administrative controls are imposed from above. Another critical dimension of Iran's currency collapse is how it feeds directly into social pressure and political instability, creating feedback loops that extend well beyond economics. When the rial loses value this rapidly, everyday life becomes unpredictable. Salaries are paid in a currency that depreciates almost immediately, while essential goods are priced either implicitly or explicitly in dollars. This gap destroys the concept of a stable middle class. Teachers, healthcare workers, civil servants, and small business owners find themselves falling behind month after month, even if their nominal income rises. The psychological effect of this erosion is powerful. People stop thinking in terms of progress or improvement and begin thinking purely in terms of survival. That shift matters because it changes behavior at scale. Protests, strikes, and informal resistance become more frequent, not necessarily because of ideology, but because economic pain becomes impossible to absorb quietly. History shows that currency collapses often precede broader unrest, precisely because they strip governments of one of their most important tools: the ability to smooth shocks over time. Inflation accelerates hardship instead of spreading it. In Iran's case, decades of sanctions, combined with limited access to global capital markets, mean there are few external buffers left. The state cannot easily borrow in foreign currency, stabilize the exchange rate through reserves, or attract investment to offset domestic weakness. As a result, pressure builds internally. Businesses reduce staff or close entirely. Informal employment expands. And younger generations face an economy with shrinking opportunity and rising costs. This fuels capital flight, both physical and human. Skilled workers seek ways to leave, while those who remain try to move savings abroad through informal channels, cryptocurrencies, or hard assets. Each of these actions weakens the domestic currency further. The rial's collapse is therefore not just a symptom of economic stress. It is an accelerant of social fragmentation. Financial trust breaks down not only between citizens and the state, but between buyers and sellers, employers and workers, lenders and borrowers. Contracts become shorter, promises less credible, and cooperation more fragile. In this environment, even well-intentioned reforms struggle to gain traction because the population no longer believes outcomes will be stable enough to matter. This is why severe currency crises are so difficult to reverse once they reach this stage. They are no longer purely monetary events. They become societal crises expressed through money. The exchange rate simply becomes the most visible scoreboard of deeper institutional erosion. Another layer that makes Iran's situation especially dangerous is how external isolation magnifies internal monetary failure, leaving almost no release valve once confidence collapses. In many historical currency crises, countries eventually stabilize through access to foreign credit, multilateral support, export surges, or renewed investor confidence. Iran lacks most of these options. Sanctions severely restrict access to international banking, limit oil revenue flexibility, and complicate trade settlement even with willing partners. This means foreign currency inflows are irregular, opaque, and often routed through informal or inefficient channels. As the rial weakens past extreme thresholds like 1.4 million to the dollar, the cost of doing business internationally rises not just in price terms, but in friction and risk. Importers must prepay, intermediaries charge higher premiums, and delays multiply. These costs are passed directly to consumers, compounding inflation beyond what official statistics capture. At the same time, the government faces rising fiscal stress. Subsidies for fuel, food, and basic goods become exponentially more expensive as the currency weakens. Yet removing them risks immediate backlash. Financing these subsidies through money creation only accelerates inflation further. This trap is one of the most severe in macroeconomics. Fiscal needs force monetary expansion. Monetary expansion destroys currency value, and currency destruction increases fiscal needs. The cycle feeds on itself. Meanwhile, capital controls and multiple exchange rates create distortions that reward arbitrage rather than productivity. Those with political connections or access to preferential rates can extract enormous rents, while the rest of the economy operates at market rates that reflect fear rather than fundamentals. This deepens inequality and corrodes trust in institutions. Businesses that could otherwise be competitive focus on survival strategies, inventory hoarding, currency speculation, or informal trade, instead of investment and innovation. Long-term planning disappears. Even infrastructure and maintenance suffer, because costs become unpredictable and funding unreliable. From a financial perspective, this environment destroys the signaling function of prices. When inflation is high and volatile, prices stop conveying information about supply and demand and start conveying fear. That makes economic coordination extremely difficult. The rial's collapse therefore represents more than weakness. It represents a loss of monetary coherence. Without a credible currency, contracts shorten, investment horizons shrink, and productivity collapses regardless of labor or resource availability. This is why Iran's crisis cannot be solved by technical fixes alone. Exchange rate management, interest rate hikes, or enforcement measures may slow visible deterioration temporarily, but they cannot rebuild confidence without structural change. The broader implications and consequences of Iran's currency collapse are far-reaching. After the currency collapses to levels like 1.4 million rials to the dollar, it is no longer about restoring past stability. It becomes about preventing economic disintegration and preventing total economic collapse. At this stage, even drastic measures have significant risks and should be approached with caution. A sharp tightening of monetary policy might result in a crushing blow to what is left of domestic activity and employment. Simultaneously, a sudden currency reform or redenomination, without a restored sense of confidence, would likely fail, and it will likely further undermine the already fragile trust in the currency system. The ongoing money creation risks tipping the balance toward even higher inflation rates and further destabilization. As a result, each path taken involves pain, and the markets are well aware of this. This is why confidence quickly dissipates as each crisis unfolds. For ordinary citizens, the immediacy of the consequences are tangible and directly affecting their daily lives. Savings are evaporating, long-term goals are disrupted, and economic behavior becomes increasingly short-term and defensive. For the state, the loss of credibility with the currency, a fundamental symbol of economic management, becomes increasingly difficult to maintain. Moreover, this crisis carries external spillover implications, affecting regional trade, energy markets, migration patterns, and geopolitical calculations. Confronted with currency crises, these challenges are rarely contained. They weaken institutions, distort incentives, and increase the unpredictability in already fragile environments. For financial institutions like Iran, this experience provides a stark demonstration of the long-term consequences of prolonged inflation, restricted access to global markets, and a lack of policy credibility. The currency collapse occurred over a longer period, and its collapse was not sudden. Rather, it occurred because each incremental loss of confidence was allowed to become permanent. Once this accumulation reached a tipping point, the decline accelerated beyond control. Rebuilding from positions such as these is not an impossible task. However, this requires conditions that go far beyond technical adjustments. A strong commitment to credible institutions, restored external access, sound fiscal management, and fostering a mutual belief in the future. Economic stability are necessary to begin rebuilding trust in the currency system. Until such conditions prevail, continued dissatisfaction with the currency's undervaluation will persist. This dissatisfaction effectively acts as a real-time referendum on trust. Right now, this referendum is delivering a clear and deeply painful verdict.